Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. I'm currently sitting in Novato, California, and then joining us from Switzerland is Michael Bishop. Michael, welcome back from all your holidays you've been taking this year, man.
Well, I'm happy to be here.
Okay. You're almost making me wish. Well, of course, I can't complain. I've been away from home now almost 3 months, and my wife and I were just chatting that in 12 more days we will be putting our cat on the airplane and heading back to Hawaii. So we're quite pleased with that aspect of being able to head back to Hawaii in the very near future. But we will have one more Bay Area Moneymaker meeting, in person at the Masonic coming up in next weekend on the 1st of October. So Michael, so what was the best place that you vacationed at this year?
Germany, the sea, the East Sea of Germany. That was pretty amazing.
And so,
I mean,
well,
it looks like Caribbean beaches,
oh, no
but
kidding.
the weather is cold almost all the time, and
Yeah,
so there are not many tourists, at least in June, not, and it's really poor nature, and it's a nice area, definitely.
cool. And so, now, did you say that was the Eastern Sea of Germany?
Yeah, so actually it's the former GDR,
Oh, okay, okay, got it. So,
the to the border.
and so, okay. Want to remind you that all the materials that we do present are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. And then here's Michael's disclaimer. Uh, it's a European disclaimer going through all the information that he's not offering anything for sale, but he works as an independent investment advisor for a Swiss wealth management company. And if you want to reach Mike, you can. There's his email right there. And I always love it when Mike's on the phone because he brings a lot of experience and also knowledge of what's going on in Europe, and gives a nice European perspective of what's going on. So I want to remind everybody, we have been doing topics over the last couple of months with our training sessions for the premium active trend trading members, and we also provide copies of this training for people who are like the early warning folks and all that kind of stuff. But we've been doing a series of trainings that will help folks have the tools ready to use in order to um, be ready for the potential of a seasonal year-end rally. But some folks have been applying what they've been learning over the last few weeks and have been doing quite well. I've been getting emails from folks saying, that they're really enjoying this meeting and everything's kind of coming together and making sense for them. And so, when I get an email, when I get emails like that, I just feel really good when the little things that we're doing is in fact translating to success for the traders who are taking the time and investing in their own education. And so this coming week, we're going to be talking about how to find rock solid support and resistance, part 2. And then there will be a follow-on part 3 that's related, that is basically going to wrap it all up into a nice little bundle for, okay, now that we know this stuff, how do we plan our action around it? And as we're all aware, the market right now is not in a very giving type of mood. It gives a little bit and then it takes it away a couple of days later. We may be seeing that today in the markets. So let's talk a little bit about what's going on. Last week we were kind of like in a holding pattern, waiting for the Fed to meet. The Fed met and it made its announcements, and it turns out that the Fed announcement equaled basically a non-event. But because they took no action regarding rates, I'm anticipating, and this is an opinion only, I'm anticipating that the Fed will not raise rates until the December time frame. And that's probably the earliest they're going to raise rates because, you know, there's one more Fed meeting that happens around November 2nd, and that's just too close to the correlation, you know, too close to the U.S. elections. Um, I won't be, you know, I'm not going to go into what the Fed's action or inaction having to do with the election, but that is something that's coming up that everybody's keeping their eye on. So that's an upcoming item. And it appears, since if the Fed is going to basically lay low, not do any decision making or any longer term planning than what they're doing right now, then probably the U.S. election will be the big driver of the market going forward. Um, and so, as I state up here, the Fed was a non-event, you know, damn the torpedoes, full speed ahead. And we had a lot of people, a lot of commentators out there recommending, hey, jump right in the back of the market right now. Everything's wonderful, great, gorgeous. It's a long time, you know, it's a great time to start buying again. I won't necessarily disagree with that or agree with that. I'll just say that basically, hey, follow your system. When you get a good buy signal, take it. And then you may want to reel in your expectations a little bit. In other words, if you're expecting a 15 to 20% pop, be happy with a 5 to 10% pop because of how fluctuating the markets are. The S&P has turned out to be the weakest of the three tracking indexes. And so my question is, you know, is there enough momentum to actually push it back up to its, you know, previous highs this year? NASDAQ broke out to new highs after the Fed meeting. You know, now does it have clear skies so it can keep running up and running hard? That's something we'll be waiting for, you know, to take place over the next couple of weeks to get a clearer indication. But right now we can use the breakout level that the NASDAQ did put out for us as a level of support for planning trades off with the NASDAQ ETFs and or the leveraged index ETFs on the NASDAQ. Russell attempted a breakout, but when I did up these slides, it had actually come back down below the breakout level. Normally, we expect if the rates remain low for some more, you know, a little bit longer, we expect the S&P to do well. So, U.S. banks, U.S. election coming up. The foreign central banks are still pouring money into the U.S. stock market at record levels. Then, you know, we have to question also, you know, how strong is the U.S. economy? One would think that if the economy were as strong as some people like to portray it, that the Feds would not have any problem raising rates. And, you know, and so since this year has been out of kilter a little bit, my big question comes is, will the year-end rally actually start a little bit early and actually exhaust itself before we get to December? Because I can just envision that, you know, in December, after the elections are over, no matter who gets elected, I could see the Fed going, okay, we've got a green light to start raising rates again. Because you have to remember that as the Fed raises rates, it puts silver bullets back into their, you know, gives them silver bullets to use just in case the, you know, the economy really turns rotten. So, what are you seeing over in the European? What's the European outlook there, Michael?
Yeah, I mean, it was pretty calm. Not much news coming out. Maybe you have heard that Deutsche Bank is really into troubles, but I think that this takes time, so there's not really a big crisis just around the corner.
Okay.
And then there is an Italian bank that is almost, or that is in fact bankrupt, and they're kicking down the can who if the government, the ECB, uh, they're working on the rescue concept, but they don't let it go down for the
Yeah.
moment, and I think that's also something where this will not explode just overnight. And yeah, and the indices, they had a nice recovery. So Swiss market and German markets are um, kind of, or it looked like we can maybe then look to a couple of charts. German market looked like a bear market, but now it's stretching around 200 days moving average, and Switzerland is, I think, in dollar notion even on a new high, or stretching on a new high. So it looks, so everything looks better than a couple of months before it, that you could say.
Okay, awesome. And so, yeah, Mike Traeger just joined us from Dallas, Texas. Mike, if you can, we're just basically kind of going over what's going on in the U.S. economy and the action or inaction by the Fed. And I know that you certainly have some pretty strong thoughts about what's going on out there. Um, would you like to share?
Yeah, sorry I was a few minutes late, sort of dialing in today. What I like to share. Nothing's changed. Nothing's changed. I mean, again, in my opinion, and I know it's not just my opinion, the Fed is completely lacking in credibility. And, the markets are going to have a knee-jerk reaction to the fact that they want to keep interest rates, lower for longer. But the underlying fundamentals and what's going on in the U.S. and the global economies, I mean, nothing's really changed. There are some signs that things are getting really bad. I just came in on the tail end of some of Michael's comments, and I heard him mention, the situation with one of the Italian banks, which I'm aware of. My question to Michael is, I think potentially a bigger issue is what's going on at Deutsche Bank in Germany. And what are you hearing about that over there?
Well, I mean, I'm not totally familiar what how the regulations in Germany look like, but as my guess is that at least the retail business, or also um, the business, so you could say all the classical banking business uh, will go on no matter within Deutsche Bank, no matter what happens with Deutsche Bank. That's just my prediction. Deutsche Bank is too big and too important for Germany and for Europe to let them down, and they have, same with the Swiss banks, they have talked in the last 8 years to split them and to have failover concepts, etc. And internally, they have, I'm sure they have some business continuity plans in case really it falls apart. But that's very personal opinion, and I have really no insights there. But my prediction is that it would need an external kind of binary event to bring it in really deep troubles right now.
Okay.
I think all the risk now known can be, it's like the budget of Japan or so. they are not willed to have a crisis right now, and so, and I think in the current situation they have a lot of tools available internally, externally, not just to let this explode.
Yeah, well, yeah, that sort of validates or confirms what I've been reading. I mean, Deutsche Bank is in big trouble, and Deutsche Bank is huge, and it is so big. You know, it's not going to be another Lehman Brothers, which, you know, here in the U.S. back in '08, you know, the Feds let Lehman Brothers go down. You know, the Germans can't let Deutsche Bank go down, so they're going to require a bailout, and they will get bailed out, and it's going to cost the taxpayers in Germany billions of dollars because Deutsche Bank is that big. And what effect that's going to have, you know, when push comes to shove and that news is hitting the headlines, what effect is that going to have on the global markets and the U.S. markets remains to be seen. It may be kind of a non-event, but or it may be kind of a trigger to the downside. Don't know, but it's an indication that things aren't as good as the indexes want to indicate.
Yeah. Well,
or maybe to sum it up, and it's just I have the same view as you have. So my prediction or guess would rather be that a market event brings Deutsche Bank down than the other way around.
Okay, that's it. Yeah, that's an interesting perspective. One of the things that, you know, and I'll just interject here also, just, you know, go back and look at the charts over the last, you know, couple of years. You know, we've had these events that have, you know, Brexit is a perfect example of that. You can basically get this little flash crash, but then bam, things, you know, turn right back around. And all the flash crashes turn out to be really excellent buying, you know, good short to intermediate term buying opportunities. And one of the things I'm looking at, and this is one thing that technical guys do, is they look for change in the personality of the price action. And at this point, we're still not getting that absolute change of personality. And when I say change of personality, what I'm talking specifically about is, you know, you see one of these, what would have been a flash crash in the past, but all of a sudden it doesn't come back as hard as it did, you know, as hard as it has in the past. And that's where, you know, the personality of the market starts to change. Now we know that, you know, the market environment has changed a lot since 2008, and it could be dependent on our perspective. We look at it and say, well, that's not a good thing because things are being held up artificially, or apparently artificially. But then we can also argue the other side of the thing, and well, that's what the central banks are supposed to do. But is it really what they're supposed to do? Anyway, good discussion, guys.
Yeah, that's an argument or a debate that could be had, and you know, it is not what the central bank, in my opinion. Well, again, it's not just my opinion. It's not what the central banks are supposed to do. It's not what they were chartered to do. It's not why, certainly, not why it was created. But it is the role that they have come to assume, and until and unless something changes.
Yep. So here's where the 20-day percentage stocks on the NYSE above their 20-day moving average was last week. It was just down here coming off a bottom. As we see as we move forward to this week, well, it came up with its bottom very nicely. Those of you who are early warning alert system guys, you got a early alert here saying standby, and you got a buy alert the very following day, and that position has moved up somewhere about 5 to 6% on trading UPRO. If you were trading TNA or TQQ, you'd be up a little bit more, but that's okay. As we see right now, nothing really that is either predictive or anything at this point other than we popped up, on this nice little short rally. And as I was saying, I'm looking for as I was saying is we're looking for something different to happen, and right now it's not totally happening. We got a nice little rally in the spiders or the S&P back up into an area of resistance, and then it has fallen back down a little bit today. So yesterday and today, Wednesday, Thursday, still celebrating the Fed's inaction and a little bit of a pullback today. Rick asked the question, do you mean when it crosses a 30? No, Rick, I don't. There's some other proprietary indicators that Mike and I look at for actually triggering trades into that item. We use this as a preliminary indication only to say, okay, we are exceptionally oversold, and that's when we start waiting for the other things to take a place. Mike, you got anything on the dailies here?
No, absolutely not. This works best at extremes, mostly extremes to the downside, and it's floundering around in the middle. There's really nothing to take away from it.
Yep. And then on the percentage of stocks above their 200-day moving average, same indices, it is in fact reversed up a little bit and pushed back up. And all we're doing until the S&P actually breaks out the top of its where it's been hammering its head for a couple, about a month or so now, until we actually get a breakout above the about 217 level on the or 2170 on the S&P. We'll look at that chart here shortly. The uptrend is confined. Not so with either the NASDAQ or the other. And again, not a lot to write home about here. Again, it can function the same way. We just look at the 200-day moving average for longer term biases, and right now it's still pointing up. So let's see, here's where we were as of about 9 o'clock this morning. The Dow is, up for the year, slightly below its all-time high. NASDAQ, or the S&P, above its all-time high, same with the NASDAQ and the NASDAQ composite. The Russell has made a really nice run over the last few weeks. Got a really nice pop yesterday and the day before when the Feds decided to leave the rates alone. So let's go to the charts. That's where I'm going to shrink this down a little bit. There we go. Let's go to the charts and see what we're looking at. Okay, here is the S&P. And if we basically just take a look at okay, this was Friday a couple of weeks ago when some of the Fed presidents came out and said, it just made it sound like absolutely for certain the Fed was going to raise rates this time, this meeting. And as you can see, that was the reaction. Then on Monday, one of the other Fed presidents comes and says, oh, well, no, we're going to hold off and not make any decision. You get a rally back up, and you get a squish back down, and then basically it stabilized around the 100-day moving average and then popped off of that. These 4 days here, or 3 days here, were basically in a holding pattern waiting for the Fed, and the market liked what the Fed did with basically leaving rates alone, allowing for plenty of money out there, plenty of additional liquidity, and we get a nice rally after the Fed announcement on Wednesday. Thursday, you get a gap up, and today what we're doing is we're basically filling this gap here on the if we take a look at this real quickly, what we've got going on here is you've got a level of resistance about there, up here. Anyway, just about the 2170 level, and then that level that forms a zone of resistance in here that runs up to the past high of 2193.81 and down to this level. As you can see, we fell down below it earlier today. We'll see where we finish. On the weekly chart, some positives that we're seeing. We're getting a reversal above the zero line on the weekly chart, which can be good. If we also connect the highs in here on momentum, the momentum on the S&P has just about, it's knocking its head against this downtrending line. If it breaks above it, I would be looking for, I would be looking for a challenge up here at 2193, and if it breaks through that, then we'll probably get a break through this trend line here that's acting as resistance right now to push things higher. We'll see, and I think this will be telltale going into the end of the year, is what type of a rebound do we get on the true strength indicator. And if it turns out to be a negative divergent type of, that may show us that later in the year, maybe December time frame is where I'm kind of shaping up now. Maybe December time frame is when the market would be under no pressure to stay up. So Mike or Michael, any comments on the S&P?
Yeah, not really. Nothing that you haven't covered here. It's pretty easy to sort of visually project as price approaches that 2190 area that we may be putting in negative divergences on the oscillators.
Yeah.
But that's a projection, and certainly nothing actionable at this point in time. I think a lot's just going to ride on what happens with the election.
Yeah.
And I think that we're going to stay kind of range bound until then.
Yeah, and for right now, what I'm looking at.
How many days do we have till the election?
What's that, Mike?
How many days do we have to the election?
Oh, I can do it to you.
On November 8th, I think. It's still about 6 weeks away.
Yeah.
6 weeks.
Yeah. No, November 8th, and please all make a note in your trading journals that November 8th is Dennis's birthday. And so, cards and letters would be appreciated. Just kidding. No, it actually is my birthday, but the last time that I can remember there was a election on my birthday, it didn't go the way I wanted it to. I was very disappointed. And Eric says, and I won't tell you what year it was, Michael. Anyway, too many. Eric says too many days left, and the TV ads are killing me. And that's one of the nice things about being in California for the election cycle. There actually are very few. Plus, I'm not watching any TV, so that's why I'm not seeing them. But there's actually very few political ads out here. Because they figure, why do political ads when since they're basically the election's already determined out in California. So Eric's in a swing state, so that's why he's getting it. Anyway, here's what I'm looking for, guys. Just get back to business here. Is we had a nice little surge. Now, what kind of a reaction are we going to get here? If we get a reaction back on a daily basis to around the moving average clusters, because we've got a really nice cluster, the 50-day, the 8-day, and the 20-day all together. If we get back in this level, that I would be looking at and we stabilize, that would possibly be a good place to go long for at least a trip back up to the previous highs, or even to break out from those. But one thing that the S&P sometimes does, it'll give you one little day down and then zoom, it's off to the races again. So that's one thing to be looking for. But I like it down in those levels. If we throw a fib on that real quick, just from high-low, we may be able to throw a fib on there. There we go. as you can see, if we get down into those moving average areas, it'll be about a 382 retracement, which oftentimes um, is a good bounce area, and if not there, down here at the 50% retracement, somewhere in the fib box would be just a healthy pullback on it for the continuation of a move up. Now, whether we
that there is an observation daily chart of the S&P, and it's mostly due to that big down day we had a couple of weeks ago.
This one, yeah.
Yeah, I mean, and that was a hugely bearish day. It took out the lows going back, to early July, like 2 months worth of, price action. And so what we're seeing again, and I know I've said it before, since, early to mid-August, we've put in a short series of lower highs and lower lows. And this rally we've experienced the last few days has come back to do nothing more, really, at least as of now, but put in a lower high.
Yep.
And that's the S&P chart. That certainly isn't the NASDAQ chart, but, lower highs and lower lows is the very definition of a downtrend.
And that is correct. Let's take a look at the NASDAQ. Okay, as we see with the NASDAQ, what the NASDAQ has done, much healthier rebound, broke out here at this level of about 48.37, and right now, as long as that level, that 48, 48.40, 48.37, 38 level remains intact, I'll be looking to utilize that since old resistance turns into new support as a level for potential bounces. We'll see what happens here. Not a lot to tell us here on the, a little bit of negative divergence on the true strength indicator, but it also can be interpreted that it's starting to roll back up. And the momentum itself, as you can see on a weekly chart, has pushed to a higher level with the NASDAQ. But it's it's up there in significantly overbought conditions, and but as we said, the rally the rally is continuing very nicely. Any speculation, guys, on why did the tech-heavy NASDAQ come off of this little flash crash over here much more strongly than the S&P did?
Take a look at the chart of Apple.
Yeah, yeah. Plus Amazon.
Well, there you go. Yeah, you're absolutely right. Apple came down here and did a really awesome. What was driving the Apple reversal here?
It was the iPhone 7 release.
Okay.
And, Apple, I mean, yeah, you look at the weekly chart of Apple, and that's not a strong chart, going back, gosh, what, a year and a half now.
Yeah, back to...
but, Apple still is an elephant and has a very large market cap, and still, especially influential because of that in the NASDAQ index. And so, price action of this sort in Apple, and I would also say that about, other entities like Google,
right?
Hugely influence the index. And even though the iPhone 7 is not getting strong reviews, and I don't know that it's the big game changer that previous releases by Apple have been, the price action has responded nonetheless, and I think it's been a big driving influence on the NASDAQ.
Yeah, just popping through several of those Apple, Amazon. You can also probably throw in Facebook. Did you know I read something the other day that Facebook is one of the most heavily invested in entity that's out there, and that's very interesting. but I found that. One part of today's decline in Apple comments from an analyst. Judy passed on that to Apple. Great deal. Gary also posts is that the Samsung battery issue with it wasn't their phone, but it was that that quasi mix between a phone and a tablet, right?
Yeah, it was their what they call their notebook phone or something like that.
Yeah. But I did understand that they're making an offer when they're selling those now. They're selling them with a free bag of marshmallows. Anyway.
That's actually pretty funny. Hey, I'll tell you how much trouble Apple is in, in the long term as a company.
Yeah.
And it was a news item this week. I think they're in the process of buying a company called McLaren. McLaren is an automotive company. They make a very, very expensive, very exotic sports car.
Okay.
And they have a, pretty well-known, Formula One racing team that they sponsor. And apparently McLaren is involved on the cutting edge of some automotive technologies. So Apple is in the process of acquiring McLaren in order to gain access to that automotive technology. And, it's just an age-old story that when a company like Apple can't keep up its rate of growth anymore because, they just can't come up with really innovative new products like they have in the past to drive their growth, that they start to branch out into areas away from their core competencies, and they start turning into little mini conglomerates. And in my mind, and based on, that kind of history, it does not bode well for Apple in the long run.
Yeah. I mean, because you saw something similar to like with
same thing happened with Microsoft.
That's exactly because I think, personally I believe Apple is the next Microsoft from that aspect. I mean, its huge growth days are behind it, and as you said, it's got so much cash, available to them. They've got to find ways to get that to work. But yeah, I think that technology had to do with the driverless technology.
Yeah, the driverless and electric.
And so,
I mean, what I'm wondering there, because McLaren, they produce, I think, 1,000 cars a year, something like that, so they don't have a mass production and all the logistics, etc., needed for making a Tesla 3, for instance.
Yeah.
No, well, some of those cars have price tags of nearly $1 million on them also.
Yeah.
And so, I did see one of one of the new, is it Model X? Is that the new Tesla model?
The SUV?
Yeah.
Yeah, I've seen a few of them around here in Dallas.
Yeah, it looks a lot like a pregnant Prius. But anyway, I saw one up here in Marin County. Surprise, and I just kind of went, it's lost its sleekness. It doesn't have, there's nothing sleek about the car whatsoever. But but that's okay. That's just art. Beauty's in the eye of the beholder. Hey, here's what the Russell's doing, guys, and here's what I was talking about last night in the update. We broke out of from above the highs set for the year a couple of weeks ago, but then now today we're getting basically a what could be a one-day reversal. However, positives on this index is, one, we do have the short-term moving averages turning around, facing back up and all kinds of stuff. That's very positive, but it is at the same time quickly, the move has pushed it up so fast, it gets extended away from these moving averages, and then it has to wait either for the moving averages to catch up and or pull back into the moving averages. Again, what I'd be looking at let's see what happens if we do this. If I take a button right about the midsection of this large candle, as you can see, that puts it about 1242 would be a promising retracement. And if we throw on a fib on this, I'll get rid of the other drawings before I draw this fib. If we throw a fib on this from high-low, I just want to, let's see. There we go, that's close enough. Yeah, that 50% pullback on this week's candle only puts us down to a retracement to about 382% retracement. And so that's a good strong level, and then down below that you've got the 50%, which also corresponds with a fairly good level of past support, which our past resistance, which now is support. And so that's what I'm looking at right now. Mike and Michael, I'm in gear right now to basically just trade the pullbacks and keep trading the pullbacks until they stop working. But right now the pullbacks have continued to work even when it's been one of these crazy flash crash type of events.
One interesting observation for me, and I never really looked at it this way before now on the weekly chart of the Russell.
Yeah.
And this is a setup that has taken just about a year to develop.
Mm-hmm.
Inverse head and shoulders.
Yep.
And the neckline of that inverse head and shoulders has been pretty definitively broken.
Yep.
And according to traditional technical analysis, if you take the distance of the price action from the head of the formation to the neckline, and you add that to the price level at the neckline, it kind of gives you a target for where things can eventually go. And that differential is about 250 points.
Okay.
So if you were to add 250 points to that 1200 level, 1200 or so,
yep,
where the neckline is,
yep,
you potentially could have a target of 1450 for the Russell.
Yep.
Whether it realizes that target and how long it might take to get there and what might happen along the way remains to be seen. But it is a valid technical setup.
Yeah, and oftentimes the way they measure that on how long it may take is they go over to where the where the left shoulder starts, and you extend a line across over to where it kind of like broke out, and you can see there that's 328 days. So that's about a year's worth of data to get for the pattern to work out. Inverse head and shoulders is called a Kilroy because Kilroy was here. Yeah, it does look a little bit like Kilroy there, Eric. Tracy asks, what thoughts on Tesla not being able to sell their cars in MI, which is Michigan, correct? Or is that Minnesota?
MI is Michigan. MN, I think, Minnesota.
Michigan, okay. I really have no comments on that, Tracy. I was not aware that Michigan was saying you couldn't sell Teslas up there. Is it because of the car? Or is it because of I know some of the car selling facilities, they have really strict rules within the state that kind of keeps okay, court ruling of state law. Yeah.
Yeah, I think the potential headwinds for Tesla in the future are much greater than not being able to sell cars in Michigan.
Yeah, so do I. I mean, I still like Tesla. It still puts in a great pattern. Sounds like a communist country to me. Well, I'm not going to make. Well, I haven't. Yeah, I mean, Michigan's been going that way anyway, from what I understand. And so the thing of trying to keep competition out of states, that in fact is nothing new. So it is frustrating. But anyway, so anything else on the Russell? Mike, thanks for pointing out. And I did draw what you're seeing as the head and shoulders correctly, did I not?
Yeah, you did.
Okay. So Michael, anything on the on the Russell?
No, no, not
Okay.
really.
Well, then we'll wrap this sucker up. Here is something that I just thought was absolutely hilarious. An article hit the news thing on Thinkorswim this morning, but it was this guy was coming out and this Sven Hendrik, but the article was actually written by a lady named Barbara Kohlmeyer, who writes for Market Watch, but it's talking about the SpongeBob market. And apparently, you know, SpongeBob is this cartoon character what's his name, SpongeBob SquarePants or something like that. But it was showing that when they came out with news that there was going to be a strong case, and Rosengren put this out, strong case for a rate increase, the market fell out of the sky. SpongeBob loses it, starts screaming all the way down, and then they're sitting there chattering their teeth. The teeth are chattering as, will she raise, won't she raise, oh my gosh, goes across here. And then all of a sudden, the market, after the action of Thursday, you know, SpongeBob is back into his happy dance mode as the market's gone up. But what I found interesting within the article, apparently the Fed, in the Fed comments, this Sven Hendrik picked up on this. It says investors should be cognizant that prices higher here are driven by two factors only. And I think you're going to like this, Mike. Performance chasing by underperforming funds, and global central banks adding liquidity at a record pace as there is policy panic about the lack of global growth, productivity, and real, highlight that word, real investment. I thought that was a very interesting comment that was taken from the Fed minutes.
Yeah, I just read that the Swiss National Bank has a bigger share in Facebook stocks than Mark Zuckerberg.
Okay. Hey.
Do they really?
Yeah, yeah.
Wow. Well, I know that they've got close to $2 billion in Apple stock. I didn't know about their science of the position in Facebook.
Yeah, so it's kind of interesting that even our Fed is basically saying that all these the funds that are flowing in the market are not considered real investment. Yeah, they're propping up the prices, but what happens when the well dries up?
I think, you know, I have a different interpretation of this, and when this commentator speaks about the lack of real investment, what he is talking about is the lack of, you know, investment in real production on the part of, you know, the private sector, the private corporations.
Yeah.
Who are borrowing money, you know, hand over fist because interest rates are so cheap, but instead of using that money to, you know, build factories, expand operations, you know, hire more people to go to work, which is what you would think of as real productive investment, what they're doing is borrowing money and buying back their stock, which we've talked about before, which is not considered to be real productive investment at all. And that's kind of the way I interpret, you know, the phrasing here.
Okay. Well, like I said, apparently this phrase came from the Fed minutes. It isn't, you know, Sven Hendrik was just the guy who picked it up. But that does bespeak into, you know, so basically what it's etching out is global growth, productivity, and real investment, which these three, you know, kind of like these are the three horsemen, they go together for the growth and the growing of a healthy economy. And when they're lacking, yeah, it may keep growing, the market may keep doing great, but It's, as I think you've said many times, Mike, it's a house of cards. But I just wanted to share, I thought this was a really cool way or at least a creative way to talk about what was going on in the market. So
Well, yeah,
path of
my
least
dog,
resistance.
my dog, my dog does
Michael,
a happy.
I'll let you go first. What's the path of least resistance from your perspective, both short term and long term?
Are we
Michael?
waiting for Michael?
How about you, Mike?
Oh, me. Gosh, I don't feel any
Mike?
differently than I felt for a while now.
Mike,
Path of least
if you're
resistance, short
talking, I
term,
can't hear you.
sideways to up. In the very long term, I think it's down.
Okay, for this, folks, can you still hear my
Yeah, we can. Also, I can.
test, 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 test? Test, test, test,
Possibly.
test, test. Okay, thanks, Dorothy. Well, then I don't know why Mike and Michael dropped off.
No,
They are not muted.
I
But
can
anyway, I'll
hear
just go
you.
in this. Again, I think, right now I've got to go short term to intermediate term, at least probably through the elections in November, that there will be a bias to the upside. We may get some transitional type sideways movement. I am leaning more towards looking here, but this is in the December time frame. And it will be tied to the Fed, what the Fed decision is in December, because by that time the elections will be over, and so we'll move from there. And so again, Michael or Mike or Michael, if you want to jump in and say anything. I haven't got a clue
Can you not
on
hear
why
us?
we can't hear you.
Can't hear us?
But Dorothy assures me. Anyway, that's what I'm looking at there. And let's take a real quick look at this week. We had a very, really good week. Juno, we took half profit on Juno at 5%. The strategy 3 is still continuing to move up, and we're etching up towards we are just about ready to bring strategy 1 back into at least break even for the year, and we've got about $3,000 gap here between where I want my equity curve to be and where it currently is. You can hear Mike, but why can't I hear Mike?
I think now Mike has been gone.
Yeah, you guys just dropped completely off of my headsets for whatever reason. You want to try it again? Okay. Well, for whatever reason, I couldn't hear you guys. I can I don't know if it was my headset or what it was. I am back. Hey, Mike, if you can hear me, can you just give me just a real quick test? Mike dropped off. Michael, if you can hear me, just give me a quick heads up, a thumbs up, or just say something.
Yeah, so I can hear you, definitely.
Okay. So, okay, let's finish up here. And as I was saying, strategy one, we're closing on getting that back to break even, and we're going to push the equity curve up. We've got about $3,000 here to make up by the end of the month. So here's one of the trades we did. I had a question that came through earlier earlier yesterday about why did I pick Juno as a stock to get into. Well, for one reason, Juno had been, not this year, but last year had been on the IBD 50 list, so it was on my running list, and I had kind of tucked it away. And oftentimes past leaders will start showing that they want to go back into being a leader again prior to them actually making their big move, and also their fundamentals indicating that they have in fact recaptured their leadership role. And so that's where I was looking at Juno. We took a trade down here as it pulled back into the 8-day moving average on the 19th, and basically just set it out there with a stop loss if it fell back down here below 27.74, and first take 1/2 profit at 5%, which we took that on 9/21, and now we're hanging on the rest of it for 15 to 20%, or a retracement back up here to the this 100% retracement, about $35. So far we got about a profit of $345 in that we've taken in. With this pullback going here, this may not be a bad time to actually add a little bit more, or I may just wait until we push on up through the 50-day moving average to see how that works. The Tesla trade we've talked about in the past. I want to flip up there really quick though what we've been doing with the nugget trade. As you know, we jumped into nugget, and I think this nugget trade is going to actually work out really well. Jumped into the 2018 straddle nugget, the 1840 strike price. We paid approximately for 4 contracts on both sides, $6,700, which required, when we did the math, to pull in about $175 per week to meet that goal. Well, this past week we pulled in $240, and as you can see, we only sold 2 contracts on both sides, and so the volatility of this is making, I think, will make this a trade that will reach 100% much quicker than what we had anticipated. And again, this is an interesting ride, but very rich premium on the weekly options. So this the first week in October, we'll have the BAM meeting over at the Masonic Center in San Jose, and then this Wednesday, don't remember, at 6:30, part 2, finding rock solid support and resistance, part 2. And then when I get back to Hawaii, as I've shared before, I'll be working on some other training videos. Want to remind everybody that the active trend trade is based on these 5 pillars, and that whenever we look at, oftentimes people will start trading strategies before they have a rock solid system in place. The system has to drive the strategies, not the strategies driving the system, because if strategies are driving the system, that means there is not really a system. So with that, Michael, if you can hear me, thank you for joining us.
Can you hear me?
I can hear you. I've got you on speaker. I've got you on speakers right now. I have to figure out what the heck is going on with these headphones. And now I'm going to look at a couple of stocks with everybody. But yeah, thanks for your input. I appreciate it so much, my friend. Okay, let's take a look at, got a couple of requests here. Let's take a look at first Nugget. Tracy has thoughts on Nugget call selling for next week. Yeah, Tracy, what I'm looking at right now is because this is coming back and pulling back, fairly significantly, I'm going to be in more of a hurry to sell a put than a call at this particular point, but I haven't got a bounce yet. And there's no bounce in here. Like if I move back above the, above the 8-day moving average, that would be, I would sell the 20. One could look at, and this is where we talked about last week, I could look at selling maybe up here at the 22, but I'd have to know how much, yeah, let me get that up. If I can pull it over. That's not, now let me pull it over. I'd be looking at that expectation of the move for next week. And then also looking at my intraday charts to say, okay, if I'm close to a top, I want to be selling premium, or on the indicators, if it's close to a oversold condition, I want to sell calls. If it's close to an overbought position, I want to be and turning over, I want to sell calls. If it's close to an oversold condition and rolling up, I want to be selling the puts. And right now I'm with these 2 days action, I may say, hey, I'm going to sell the 18 puts or even the 1750 puts if I can get enough premium for them, and maybe go up to the 50-day moving average and sell a call somewhere between the $22.50 and the $24. So Rick asked a question, so each week do I sell only one side? No, I want to be selling both sides, but the criticality of it, what my real driving force is, I want to sell enough premium to meet my weekly target. Juno, for the balance of the Juno trade, are you following the 8-day EMA sell rule or on the target gain? On the balance of it, Dorothy, yeah, I would be basically, we could either follow the 8-day, if we get a close below the 8-day, go ahead and sell it out, or you could also just utilize the break-even rule on the remainder of the share, which would be 29.30-ish or 29.40-ish to sell out. IBB. Gary, yeah, IBB, I mean, I really like IBB. I would like to, last week you get a nice, pullback and a bounce, or week before last get a nice pullback and then a rebound. And so it looks like it wants to take off. It just is not broken above and stayed above this, 300 level yet. And so this is one where I would be looking at any type of a retracement that would be going back and revisiting these moving average or the moving average cluster of the 8 to 20 or the 50, and how much of a pullback would that be? We'd have to lay the fibs on top of that, to basically from here to there, and just take a look. We could actually pull back all the way to 50% of this retracement and be right at the 20-day moving average, or the 61.8 and be right at the 50, and then the trigger on the trade going up, we could either take it off the bounce or breaking through that next fib level. And Karen, on a great question on Tesla, we'll take a real quick look here. Maybe a partial. I already did the work on Tesla, and it's got like an $8 expectancy going into next week, plus or minus $8. And so from where it was earlier, 8 puts us about 216 to the high side. And so one could say, hey, prior to the close, I'm going to sell the 212.50 call. I'm going to leave the put alone right now, although I could go down here to approximately probably the 202 50 or the 200 put and sell, depending on how many contracts are on your base position. Like if you have two contract puts, two contract calls on your leaps, then you could basically, I would in this case do one on each side, but they would be outside my, they would be around my expected move in order to draw in enough premium. And then I would wait to next week to set up the rest of the trade. Okay. Hey guys, I'm going to call it a day. Yeah, we've gone a little bit over and I've got to figure out what the heck is going on with this microphone. So until next time, thank you very much for joining and have an absolutely fabulous weekend. Michael, have a great weekend.
Thank you. Have a nice weekend all together.
Okay, thanks buddy. Bye-bye. God bless everybody.